day and age to read any good news on the newspaper page. And love and tradition of the grand design, some people say is even harder to find.
We're live. Let's do this. Welcome to our 150th session of All Things Real Estate. We got a couple of team members missing, but we got a great guest in the house, Mr. Michael Houghton, Mr. Mortgage Broker Extraordinaire, and all that good stuff. So we'll be throwing out interesting information on where the market is for interest rates and all that good stuff, and how scared people are or how they're not. I mean, with the way that stock market today rebounded is kind of saying the story. So
what happened today?
You don't know.
I got a haircut.
Dude, go ahead, Michael. What happened?
The Fed met for their May meeting, and it is up a half a point. They thought it might have been 3/4 of a point, but it went up a half.
And what did the stock market? How did the stock market respond to that?
Stock market stayed relatively flat all morning, and then after the news, for some strange reason, it shot up 900 points. 900
points.
So they looked at it as the Fed is starting to do something to kind of cure this inflation. They've broken all our crystal balls.
Exactly.
Everything you studied in college on economics has now been thrown out the window. Everything on what the market should be doing, how it should be reacting is completely opposite. So all the triggers are all over the place.
But it's also, I think that's the sign that there is a shift. Whatever that shift, whatever pivoting it's going to be, there is a shift going on.
So anyone under the age of, 50 or 60, someone 28, myself.
See, speaking of us, Michael, what the hell is that all about?
Yeah.
Settle down, everyone.
I'm the old speed limit, 55.
Here's the magic word, recession. Instantly, they trigger housing recession. Well, 2 podcasts ago, we talked about a true recession is 2 quarters back-to-back of negative GDP growth, right? I don't think the housing market is going to be hit hard as it was in 08, 09.
Sure.
But, I mean, you guys are the, more you, not so much Mark, the economic freaks. I don't even know what, I'm totally kidding. What the heck's, what you're talking about sometimes. But in my opinion, I think the feds have to be so drastic to essentially correct all of this money that's gone. They're bringing the market down on purpose by raising interest rates so rapidly. Is that correct?
That's the intention. The thought was they should have started this a year ago.
Yep.
But they didn't. So now they're doing it drastically. Most meetings in the last 10, 15, 20 years, they've raised it by a quarter or dropped it by a quarter when things were going really good. Today was the first time in, I think they said 20 years, 30 years, where they raised it a whole half a point.
But they were actually anticipating a 3/4 of a point, even higher jump. Right?
They're looking, expect at every meeting an increase until they get it cured.
How often do they meet?
Usually every quarter they meet. Sometimes they have emergency meetings and they'll come and announce. But when the Fed raises rates, in the real estate first mortgage position, we care about the bond market and the yield on the 10-year treasury, the long-term financing. When the Fed raises the rate, it affects everything on your secondary spending. Credit cards, car payments, equity lines. If you're getting an equity line, you want equity out of your home. So all of those are now adjusting up. So the prime that it starts at is 4%. And then any adder that you have on above that. So your secondary spending is going up. All your credit card payments are going, all the debt, what they're doing is trying to shrink the debt by making less people take out debt.
Do you think they're doing it the best way possible?
Sure. Yeah, definitely.
Can you turn this off? Nice to see you guys.
Yeah, it's like, where's those political comments coming in? No, you asked that question. I mean, we had that last recession, and what's a recession really mean, right? One of the things that I believe the government powers that be have done every time there's been a major crash is they've put regulations in to avoid those same situations happening. They try to predict everything else with it. I just had this conversation with somebody today, great client, Jan Olson, giving you a shout out there. She's
shout out,
watching
Jan.
our podcast. We'll be listing our house here pretty soon too, here in Los Gatos. And the conversation we had today was, I don't believe that when we shift, we're going to see a crash. A crash being, when we had 94 hit, when we had 2006 through 2008, your crashes are 30, 40%, sometimes 50%.
And you're talking housing.
Housing.
The stock market.
Well, but the stock market all are precipitated that. I mean, it all kind of ties itself together, right? I believe that what we will see is a shift. I mean, we've talked about this before in our podcast. I mean, what we've seen where you have 10, 20 offers on a property, Like we had that one property where the offers came in, they were all between 1.4 and 1.6, and some guy comes to the table at 1.9. He has no clue what the secondary offer is at all. I believe that's the shift we're going to see, and that could provide a perception that we're crashing. But that's a fluff valuation anyways. I mean, so that's going to be the first correction that we're going to see.
One huge outlier.
Yeah, right, exactly. So I mean, if you want to share, I mean, you had a situation today where you priced a property well within all the comps and actually below that, crickets.
Yeah.
And you guys are pulling it off the market, turning it into a rental.
So when we say the market's shifting, it's really quick.
Our market shifts on a dime.
So 3 weeks ago, not exaggerating, this house all day long is listed. We could list at 1.6, 1.7, and it's going to sell for between 1.7 and 1.8.
Yes.
A 3-bedroom, 1.5 bath sold for 1.7, not dialed.
Yep.
This house is pretty done up and dialed.
A 3-bedroom, 1 bath, you said, 1,200 square feet.
This is a 3-bedroom, 2 bath. Same schools, one street over. We listed last week. I listed it at 1.698. 0 people through the open house.
Yep.
Not one person.
And that thing was dialed in. You had a remodeled kitchen.
We staged it. We didn't cut any corners.
Yep.
I said, oh shit. I told my clients, hey, we got to get ahead of this.
And this was within, 4 days, 5 days?
Yeah. But not one showing, not one person through the open house.
Right.
I dropped it Saturday night, and we dropped it 1.45. No way it doesn't. 0 showings, 0 offers.
Right. Right.
So it's our tall tale sign is we start to see the expired listings, the canceled listings.
Yes.
In this case, our client's probably going to rent it out and revisit it 6 to
So when you look at that situation, if that house would have sold for, let's conservatively say 1.7 2 months ago, and today they can't sell for 1.4, that's a huge hit in valuation if somebody was just looking at those numbers.
Because we've talked about it before, a lot of areas through this whole pandemic have been unbelievably overvalued.
100,
Cambrian is one,
100%.
Santa Teresa is one, Morgan Hill, Gilroy.
100%.
Those are another.
Absolutely.
But the good schools, like Lee High School, Los Gatos. I mean, Los Gatos also placed in the top 50 for.
Well, there's still no inventory though, right?
Still no inventory, so it just may take a little bit.
So great segue into that, because normally we start off with our market minute, but Mr. David's not here to kind of throw it out there.
Monday's mortgage market minute with Mark.
There we go. And Michael.
There we go. Oh.
He's even. I'm not as good looking as.
Wait, can I
Jim
say
Bruno,
one
though.
thing since I'm going to forget first?
Sure.
I want to say that even though your house was worth, let's say, $2 million 3 months ago, and now it's worth 1.7, you didn't lose 300,000.
100%.
You never had the money.
Right.
Just because the stock market, your Tesla was a 1 million and now it's 500,000. This is just an example.
Well,
you didn't lose 500,000. You didn't cash it out. It was just there at one point. It was worth X. You cashed it out. Now it is worth Y.
2 more takes on that. One is that house that you were using as an example a year ago would have sold for 1.2. So for that thing, maybe 2 years ago, for that thing to go from 1.2 to 1.7, now it's retreated. It's just unheard of. And then the other thing is, I was just having this conversation with Jan again. Another shout out for Jan. Jan, you go. Is that homes or your primary residence was never meant to be an investment vehicle. It was a roof over your head. That's all. Fortunately, we tell our clients when they worry about paying all their taxes for all that growth they've had, the fact is, fortunately, you bought in the orchards of Silicon Valley rather than the walnut orchards over in Stockton or Fresno, right? And that's where this value is gained. So consider yourself very lucky that our homes have turned into the vehicle for us to move on to the next chapters of our life, fund our retirement, and everything else. So going back to the market minute, let's do this because I think we're seeing some very interesting numbers that are posting. First time in my life, do you know how many active single-family homes there are? It's a very rounded number.
In Santa Clara County?
Santa Clara County.
1,000.
Oh, you're reading my notes. Exactly, 1,000.
Oh, that was a guess. But that's still crazy low.
So what I found interesting, though, pendings, we have 957 single-family homes and 297 condos for a total of 1,486. That's really the first time that we've seen kind of that 1-to-1 ratio for sales and for pendings. What does that mean? I mean, obviously, I think seasonally we see more listings come on as we get closer or further into the year, right?
Well, it means that things are sitting, right?
Well, yeah, they're sitting a little bit, or you have an increase in inventory. I've always said the red zone for sellers to sell, where any time in my career, I don't care if the market's going up, down, whatever, is going to be from February 1st until the end of May.
The red zone meaning?
The red zone that sellers will experience 2 to 3% higher in valuation if they list their house at February 1st through the end of May. And generally speaking, they're going to hit those hot spot with that right around March, April time period, because what happens is neighbors start seeing about what Bob and Mildred got for their house. So then they start, let's put our home on the market. And you start seeing that natural progression. And then in our area in the summertime, things slow down. Now, Real Estate 101 nationwide says all the time to list in the summertime because kids are out of school and everything else. In our area, because it's so affluent, kids get out of school, where do we go?
Vacation.
Everybody goes on vacation.
Especially now.
Right? Exactly, with COVID releasing us, right? So then we go through July, August, market starts coming back, and fourth quarters actually have always been my busiest months. But for valuation purposes, from a seller standpoint, through May is when we kind of see those highest numbers, with the exception when you're in a shifting market, right? So just things to keep an eye on.
Yeah, we are kind of in a stagflationary environment where, economic growth has been kind of stagnant and inflation hasn't come down yet. So I wanted to ask you, does that always lead to a recession? Or have you, the last time I think in 2004, the Feds increased the rates by 25 basis point hikes about 20 times.
Right.
And what happened to the real estate prices back then?
When was that?
2004.
By 2006, 2007, I mean,
They were shooting up.
They
to
were
the
shooting
moon.
like crazy, and then 2008 happened, and we crashed and
I was
burned.
in middle school.
I think the difference then, though, is there was inventory. But people could build. I was up in the Roseville, Placer County, Sacramento region, which was a real big boom buster. People spreading out from the Silicon Valley. But then a builder could define how much it cost them to build per square foot. Now a builder has no clue. What's a board going to cost me? What's a truss going to cost me? What's my labor going to cost me? So you can't forecast. So inventory, I've got to imagine, is going to stay tight.
Yeah. So to close, I want to come back to
Yeah.
that, because to close out inventory, going to like Los Gatos, for example, where you had mentioned, good school districts are kind of staying stagnant with their inventory or keeping it really low. Los Gatos right now, Los Gatos Schools has 41 active homes. 41. That's it. 20 of them are pending. Right? 20 of them are pending.
But that's way up from the last time we talked about
It is. All these numbers are. Shifting back to your scenario with building costs, I was meeting with a builder today, and when we go back, the first spec home we did was in the early 2000s, and it was $175 a foot, right? Not that long ago, we were building, maybe 4 years ago, we were building at $350 a foot. The last one we just did, we're hitting $500 to $600 a foot.
That's high end here.
Yeah, that's high end, yeah. But even if you're,
60 to 300 on the
sure
developers,
yeah,
right?
Exactly. And I don't know when those costs are going to be coming down. I mean, price of wood and everything is still skyrocketing.
I think the Bay Area has a really unique situation.
Yes.
In the sense that a lot of people my age were never taught how to do basic household handyman / elevated work. And what's interesting is we don't really have enough contractors.
No.
The cost
Yeah.
to do business here to get your home remodeled versus somewhere like San Diego or Arizona is a very huge,
Yeah, it is.
drastically different number.
It's funny when we go to Austin, as you guys always say. I'm the Austin guy here. They're paying a contractor down there, electrician. They're paying them $40 an hour, right? What's an electrician cost us here? $100 to $125 an hour.
Yeah.
That's where your cost per square foot really starts going up, is with those labor. And I kind of think a piece of wood costs the same here as it does in anywhere in the United States. You have the same
Doors went
issues,
from
but it's labor.
$75 to $200.
Yeah, definitely.
Doors.
Yeah. Yep. What do you got there? You making some notes?
Oh, I just thought it was super ironic, and it's perfect that you're here. One, I want your opinion on where you think rates are going to be by the end of the year.
Ooh.
Two, I, as you know, have been running quite a few flips for clients. They use private money, and that private money, most of the time we're paying a point up front and 7%. Well, now 7% is looking pretty good.
Yeah,
I mean,
absolutely.
I think what we're at 5.5.
Yeah, you're-
generally speaking right now.
A general average across the board right now on a conventional loan is 5.5%.
What does conventional mean?
Conventional means anything under about 900,000 in our counties.
Just so you guys knew, I knew that. I'm just telling you for you. Under 900,000 loan amount.
Loan amount,
So
that's
purchase
correct.
price would be.
That's correct. And then if you go anything above, then you can go jumbo, which requires some more requirements. Better FICO scores, some reserves when you close.
So where are we at on 7 arms? 7 arms are the target right now, right? Because those are in 3.5. Is that right?
They used to be. The actual price, the point that people are most looking at now is a 5-1 arm, because the difference between a 5 and a 7 could be as much as a half a point.
Let me ask you though. I mean, if I'm in that home long term, I should probably lock these rates down. Now, I mean, I remember the first house, and I know people that are even older than me can say, I remember when the rates were 15%.
Yeah.
But, early 2000s, I mean, we're at 7%. It used to be if you can get a 7% loan over the last 20 years, that'd be great. And 5% was low.
We're gonna be back. I got into this industry in '07, the last time people were jumping out of buildings, and the whole world's gonna end and crash. And so that's when I learned the industry at 7% down. We're going to hit that again in the next 18 months.
You think so?
Do
Easily.
you think that's healthy?
7%. Healthy. The problem is when COVID came, the government came in and subsidized the industry to get people to do two things: either pull equity out of their home at a low cost and get through this COVID thing nobody knew, or to keep the housing market what would trigger people to continue to buy or incentivize, and it was super low rates. My feeling is if you show somebody a 2 or 3%, that's going to be ingrained in their brain for quite a long time. So every conversation I have for the first 30 minutes right now is, hey, you're up at 5%. You can give me a half back. You can give me it. Doesn't work that way.
Yeah.
So the forecast that most people in our industry are working off of is that rates are going to continue to climb for the next 9 to 18 to 24 months.
So, Mike, what are the banks doing to provide affordable options? IOs? We got some IOs in there?
So great question. What the banks are doing is hemorrhaging right now. They're laying off people, teams.
IOs, hemorrhaging. Let's use normal words here. Jesus.
IO is interest only. So what I'm finding a lot of my clients like to do now is they know we're going to come back at some point. So at that period of time, what can I do? So instead of the interest rate being high, let's talk about lowering my payment. So a lot of people don't know that you can get interest-only loans, meaning same amount of loan, but I'm only going to pay the interest, not principal reduction. An example of that, a 4.5% interest-only loan is a cheaper payment than a 2.5% fully amortized with principal interest. Now the rate's 2 points higher, but it doesn't make sense if you haven't looked at it from a payment perspective. There's other things they're doing, 40-year amortization loans. A lot of people don't realize in China, they have 100-year amortized loans.
Wow.
Now, are you going to be in it for 100 years? Absolutely not.
And amortized means?
Means amortized over that term, 100 years. So if I take out $500,000 and it's amortized over 30 years, which is the most normal loan, you're going to pay that $500 over 30 years.
And they can do it over 100 years.
We have 40-year in a lot of our offerings with our niche lenders, but a lot of people, like in China, and the government subsidize, but it makes it affordable for people to get a home they may not be able
Mike,
to.
what I've loved about doing business with you is the options you provide, and you can sit down with somebody and saying, listen, here's your option, where I think in like my case, my payment was say $9,000 because it was fully amortized. We did an IO that dropped it down, and the payment drops $3,800.
Yep.
And that cash flow is pretty significant. So I
really
appreciate
is.
you, and invite any of our listeners and everything. Contact Michael for all of your refi mortgage needs, all that good stuff.
So we kind of
refis might be out for a while.
I know, right?
I wrote that down. Is the refi boom over?
Yeah, but let me go back to this question though,
Yeah.
because I'm a little concerned when we see these cycles happen. I mean, a downward shift is not going to be over in 2 years. And I believe that with what we've done with stimulus package, all this other stuff, and falsely, like as you said, the feds have kept it, they have falsely kept this economy going, right? For good reasons. Okay, that's great. But I don't see, as we're shifting here, that we're going to come back in 2 years or 3 years and all of a sudden have rates coming down on us. I think it's going to be a long time that we got to pay this off.
Well, and I would agree from the correct perspective, but the revenue streams that were coming into the government, the banks, they were massive, better than they've ever been in the history of mortgages.
During the pandemic.
During the last 2 years.
Yep.
It was subsidized, and those rates, it just went massive.
Right.
So after a year of not having those massive revenue streams, if they want those back, guess what they're going to do? They're going to lower the rates again, right? So they're going to drive that economy back in. When people pay their mortgages, it's a very lucrative business for banks and government and everything. It's when they can't make their payments, and that's what's scaring everybody.
Nationwide, that's a big
That's the
thing
scary
right now.
part. That's when we're in
Right.
trouble, when somebody can't make the payments. Right now, everybody's doing okay and they're making it. But the question is when they can't start making. Just to let you know, anything you read in our business, by the time you read it, it's
Isn't
always
that the
2
truth?
We
weeks.
talked about
2
that.
weeks
That's
back.
a lagging indicator.
Oh, totally.
So you're starting to see everything we've been talking about over the past month.
Right.
That just got published this week.
And the whole thing, that's where it matters who you work with, right?
Oh my
Experience,
God!
all that
Thank
stuff.
you for
There
the
we go.
segue. We jumped right into it. We never really got
talking experience?
to introduce
Age?
Mike, and I want to come from it a bit backwards in the sense that he's not the guy that's sitting at the branch when you go to
Right.
use the ATM, right? Who you work with truly does matter. It's not some silly, catchy slogan like a lot of people say it.
Right.
It's no bullshit.
Right.
Mike can I mean, I'll let him speak, but there's a million different ways you can structure a loan. So when you go to nerdwallet.com and you just are looking at that interest rate at, oh my God, Rocket Mortgage could do 3% and Wells Fargo's at 3.5%. There's a lot more that goes into it. And these guys, somebody like him is able to steer you
Right.
through it,
Right.
take your overall portfolio and realize, hey, take the higher rate because XYZ, this is going to cost you that, So
You know, we've said this so many times. It's like the wrong reason to hire an agent is based off of their commission. The same thing with a mortgage broker. You don't want to call a mortgage broker and say, hey, what's your interest rate today? And you're going to shop everybody because you can squeeze another eighth of a point or a quarter of a point because the market changes. And not to mention, is that mortgage broker going to be upfront with you to ensure that any obstacles that you have, they're going to put you in the environment that you're going to be able to get through those obstacles. And that's what somebody like Mike does.
Totally. And no one has a crystal ball, but he knows, hey, job report comes out tomorrow. Let's rate lock today as opposed to tomorrow. Or, I mean, the guy is no dummy. He's a freaking genius, right? So,
What am I doing here?
Yeah, I mean, if you
Love
don't,
you guys.
not everyone needs the 20%. There's a million ways he can help
Right.
structure you
Yeah.
to be able to afford, and get you to the next step.
Right. What we're starting to see now is the turn in the mortgage business. We're starting to see programs come out to help the investors. So they want to keep that purchase market going. So they're going to have less down payment for investment properties, less down payment for first-time home buyers, higher loan limits for first-time home buyers. You can get a fourplex now with 5% down, almost to $2 million on a conventional conforming loan. That means you get 2 or 3 or 4 of your friends together. It's your primary with 5% down. $20,000 each. You can buy a $2 million property.
I
mean,
think
it's crazy the programs you can get to get out there. You just have to come in and go through the process and ask the questions and see what you're eligible for.
Fair to say that they are wanting investors, but that's long term. Everyone, I probably had 20 people send me that article that came out that said short term flippers are going to be taxed at a much higher rate because that is what's driving. I call this market shiny object syndrome. People are paying for that quick flip as opposed to.
Okay, so we had this conversation the other day where, why? And by the way, California's not the. New York City has a flipper tax, and this is starting to get.
They already have it.
Exactly. It's starting to gain some speed, right? So I sit there and say, okay, I believe the reason why the government's putting that regulation on there that obstacle is they want to encourage owner users, right? However, I sit there and I say, okay, if that flipper tax, I think they're only saying it's for 1 year, right? So if you flip a house in a
Anything
year,
less than a year.
anything less than a year.
Jeet knows this
Okay,
stuff.
so listen, is that right?
Yeah, I
Okay.
think it's under.
So if I'm a
1 year.
flipper, and I'm going to, I believe what that's going to do is it's going to make remodeled, newer homes a more rare commodity. So I think it's going to backfire on the owner user because now if I'm a flipper, we do spec homes. I'm just going to hold. I mean, listen, it takes me 2 to 3 months to get the damn thing approved, anyways. Another 8 to 9 months to build it. So I'm just going to sell it in the 13th month.
Well, and remember, in the financing world, when you buy a home, your home is what it's worth on paper in the mortgage industry for either the purchase price or the appraised value, what's ever less, for 12 months. So I have a lot of clients putting a little bit down and waiting for their 1 year anniversary because the values are going so up,
Right.
keeping their money in their portfolio, and now the home's worth 20% more, and they refinance out into
Right.
a lower interest rate or no mortgage insurance or things like that. So flipping in our world, in the finance world, we don't see it as much because you can't come in and
Well, that's
finance that
that's
property.
on the private money side,
Yeah.
right? And then that's where you're at your. I mean, I'm surprised you're saying 7% because I mean I'm seeing that is like 8 to 10, 8 to 12% in some cases.
What
Right?
happens? Who you work with matters.
Oh, damn, Gina! All right, all right. So let's mix it up. What kind of fun stuff we got here? Z,
Yeah,
what do you got
there's
to-
an article that I read recently that there's a forgivable equity builder assistance. So it's like it helps you with a down payment assistance for your first home, as long as you qualify with the income and you stay at the property. You live in the property as your primary for the first 5 years.
Yeah. What I always tell first-time home buyers, good, bad, or indifferent, the government has been giving out a lot of money for a lot of different things, okay? If you know where you want to live, or you know a neighborhood or a town or a city or a county, look at that website. They've got money to give for down payment assistance programs. There's silent seconds where you can get 5% down, 3.5% down, and you don't pay that money back. Some as long as until you sell or refinance the
Okay,
home.
so let me ask this question. This will be for Jeet and Aaron, because you guys work with more buyers than I do. Is the market softening to where you can get a home buyer into contract with a program like this in our
Did
area?
you read my notes? Tell the truth. You did.
Paybacks are a bitch.
You did. You know. Okay, so what I just wrote down, and then Jeet, you could speak on it, is there's two groups of people that I think have really gotten the short end of the stick since really 2015. Number one, veterans. To get a VA loan accepted here in the Bay Area has been so hard, unfortunately, just because of the way that it's structured. It's most of the time zero down, correct?
Zero down. You can do 100% financing for whatever you're eligible up to, depending on your service.
Yeah, and I mean, just being super realistic, a lot of people turn, whether it's real estate agents, lenders, turn that business away because it's just not practical. And, sometimes you have to look your client in the eye and say, we appreciate the hell out of the service that you've done. Right now, the market, unfortunately, doesn't bear the program that the government has put together for you to be able to buy a home. Same with FHA. So the slowdown, those people are way more motivated because they've been on the sideline. They don't really care what the price is. They just want a house.
Right. So are you seeing it softening up with that, or are
I think it's going to come in the next 21 days.
21 days? Wow.
Like the next 3 weeks, I think a lot of my friends that have great income but really struggle with the down payment are going to.
Because we're seeing more of these homes, like in your case, where, hey, they're coming in at a reasonable level. They're still not moving them as quickly as they did. Buyers going to get a little nervous and be more open up.
I've been saying it for the last 2 months, but I think it's finally happening. People are going to price at what they're willing to accept.
Yeah.
Once the houses sit for more than a week, driving multiple offers with a really low list price can backfire so quickly.
100%.
That, hey, if we could do an FHA spot approval, we could go into that. It's a process. But if you can get accepted at 3.5% down, are you interested? Because if you are, your time is coming.
Once again, the reason why who you work with matters, right?
All right, you already had your moment.
Yeah, by the way, no, nobody can read your notes. Okay, I think on that.
No, I have one more. I have one more.
Okay, go for it.
Well, then you can add whatever. I thought it was pretty interesting how many top schools the Bay Area had in the state of California.
Awesome.
Gunn, Saratoga, Los Gatos, Homestead, Monte Vista. I mean, there was
how big was this list?
It was 100, but there was, I would say,
They had it classified by public, by private.
Yeah.
It was really, we
but
had a lot of
this
schools.
area.
Well, and that.
I
There you
mean,
go.
so many different cultures from all over the world.
Right.
It's pretty cool to see how. I mean, I think schools are still underfunded, but how many people are just cranking up those ratings, and that is so heavily based on.
And that's where everyone wants to worry about all the headquarters moving out of the area and stuff. There's so much backfill coming back into here. We're still a huge brain trust. I mean, our GMP still is number 7 in the entire world or something. I mean, it's ludicrous. So good stuff. Jeet, you want to finish up with anything there? What else you got?
Yeah, I just wanted to share my experience. I'm working with quite a few buyers recently. I placed a couple of offers last week, and turns out we're placing some really strong offers preemptively, and then the listing agent's like, I have quite a bit of interest in activity, let's wait till deadline. Turns out the rates go up a little bit, and my client's like, I can no longer pay 200,000 over for this property. The home next door, exact same layout, is pending at 2 million with 3 offers. And he received 3 preemptive offers. He's like, no, let's wait. And now he's still sitting on the market because he got no offers at deadline. And even my clients backed out. So I think coming back to your point that we're going to see more transparent pricing, I think that's going to come true.
Well, it's so funny. Somebody threw that out to me. They're transparency pricing. Is that what they're calling it now?
Yeah.
Where it's like, I'm going to put my house on the market. We might just do an offer like a week from now, but if you bring me $3 million for it, that's the price. That's the price I'll sell it to you for.
I love it so much. I love it. It's so much easier. There's so much less bullshit, and buying a house is so much, so emotional.
See, I would still prefer to let it run its course.
And what
I'm saying, but you got to be aware for strategic pricing, as you mentioned, right? You got to change your pricing tactics in a market like this. But I still am I'm very strong believer in that you got to let the market set the price. You just have to.
To a point. Don't overprice, right?
No, you never want to overprice. That doesn't do anybody any good.
I mean, no one's talking about how many houses in the surrounding cities from Los Gatos have sold well over $1 million from list price.
Oh yeah. I mean, prior to the pandemic, all of our surrounding area. I mean, Los Gatos was at $1,000 to $1,100 a foot. Now Los Gatos is $1,500 to $2,200 a foot. South San Jose is at $1,100 to $1,200 a foot.
Yeah.
Crazy. All right.
I have one question.
Go ahead.
Are the Feds / Federal Reserve, is that a private or public? I mean, is that a private company, not a government?
No, it's the Federal Reserve.
Right.
Federal
Somebody
Reserve.
told me at the golf
we can
course.
do a history lesson on that.
Somebody told me at the golf course it's
What
private.
island was the Federal Reserve?
The Gen Zs never had government classes or things
Someone
like that.
Gen Z in here? I ain't no Gen Z.
Other than the two, I
Or
feel
what do they
sorry-
call them?
Michael,
I'm a millennial.
I'm
I
a
feel
millennial.
sorry
I'm
for all
sorry.
of these guys got in the business in the last 10 years because none of them had to work to save their life, right? Now it's grinding it out, with the exception of these two guys here.
They're
But,
killing it.
There
No,
you go.
it's a government agency that's supposed to be non-political. That's supposed to keep an eye and monitor and track everything we've all created.
So, one last thing.
Yes.
This time, seriously. I saw a really cool app that I couldn't wait to tell you about, and then you were. I didn't see you last week, but I think you'll think it's cool too. It's called Iris, and I actually saw it on TikTok, but I looked into it. I downloaded it, and
what's
I've been
TikTok?
using it.
What's TikTok?
Let's TikTok.
It's an American run.
Is that by my MySpace page?
It is called. My mom used to call MySpace my face. She couldn't figure out MySpace. So Iris.
Iris.
Check it out. It follows. So somebody like, no, please be unemotionally attached. Somebody like Nancy Pelosi, who has a crazy portfolio as far as properties and in the stock market. It follows every single trade that she makes.
No kidding.
And they've turned it into an ETF. Not only it's like
That's only with public officials, right?
it's
that's not private
it's
sector.
anyone that's a public official.
Yeah,
So
right.
if you want to invest like Trump, you got it. If you want to invest like Biden, you got it.
But that's just what they've disclosed. Like,
Well-
we don't know what Mr. Pelosi's been investing
Everything in the government is above board, right?
All right, so Iris.
Iris, kind of a cool thing.
How much money are they sending you to do that plug? All right, on that note, guys.
I
Yeah, thanks,
invested
you guys.
$1,000. Yeah.
I've been tracking the Russian oligarchs' yachts. I want one of the yachts. That's the app I've
I
been
think you get
following.
on 50 cents on the dollar right now.
I'm
Michael Houghton,
Yeah,
thank you
thanks,
so much
you
for
guys.
joining
Pleasure.
us today.
Anytime.
Yeah, we got Ben and David will be back next week.
If you ever have any real estate questions, let us know.
Awesome, guys. Thank
See you
you.
next time.